All right, so I've already done this interview, and it's the same day. I'm just doing the intro now, but it's Ryan Moran, the owner of capitalism.com. We spoke on stage years ago at this conference, and then I've spoken at his events a couple of times and gone out to lunch, and we actually hung out at Burning Man, and as two sober dudes pontificating on the philosophies of life. Nerdy, I know, totally, but we just dove right into some pretty cool conversation about what's going on in the economy, how to prepare for things, but really looking at all the positivity that occurs and how you can profit and be positive about this and what binds us and connects all of us and what the misinformation is that misleads people, and just really practical steps combined with plenty of philosophy. So enjoy.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions.
I want the podcast to start with, all right, let's talk about money and Jesus here for a second. So you made this comment that about how so many people view money as the root of all evil.
Right.
And so, I don't know if you know this about me, I went to school to be a pastor. So that passage in scripture is mistranslated.
Right.
Because
only part of the sentence, for one thing.
Well, yeah. Well, I mean, first of all, the exact sentence is that the love of money is the root of all kinds of evil. It's often repeated as money is the root of evil, which is not the whole sentence. But actually, the original translation is like the word love is more like obsession. The obsession with money is the root of all kinds of evil. And what is obsession? Obsession is focusing on what you do not have. That is obsession. So it's actually the lack of money, the obsession with your lack of money, what translated in English as love, is a root of all kinds of evil. So what would that look like? It would look like stealing. It would look like lying. It would look like trickery. It would look like thievery. That's what that sentence is about. It is the lack of money is the root of all kinds of evil. Boom, we're done. Capitalism for all the win. Great podcast today, Garrett.
Dude, but isn't it amazing how people are confused about this? And if they're confused about it, even if it's subtle or subconscious, think of the irony. I want more money, but I think it's bad. I want to be a good person, but if I have more money, will I be a good person? What will people, it's like all of this confused dilemma, judgment, all because of misinformation. And what I find is that we discover misinformation when there's a dilemma. The dilemma is I'm damned if I do, damned if I don't, which means you're in a myth. It means there's a lie that you've been believing that's that premise or philosophy. So essentially, you have a lot of people that put money above all else because of their obsession with it. And therefore, they don't choose to be kind to other people, or they look to take more than they give. But when I look at money, like I was just about to tell you before we hit record, I took my two sons on a wilderness survival trip. So I told them we were going camping, and then their mom broke it to them that it was more survival. Like there were tears the first night. Like, Dad, isn't camping playing cards and talking at the fire? Why are we learning to forage off the land? Why are they talking about hypothermia? What do you mean? What is happening here? And what I learned most from that is 5 days of living off the land where my money meant nothing is so hard, bro. Like, it's amazing how efficient a tool money is and what I could buy with that, because I could leverage my skills and utilize other skills so I don't have to be good at a bunch of things but not great at anything. And dude, I think that if for every American, if we just had to go live in the woods for 5 days, we would stop being complainers. Life would just be like, okay, I've got it a lot better than I thought.
Yeah, well, one of my favorite stories from our friendship was we've been to Burning Man together.
Yeah,
and
you've kind of been to Burning Man. You were like in Burning Man, but like where am I? You were very much like, what did I get myself into?
What are you talking about? I go to Burning Man every year.
Really? You were wearing you were just like wearing a t-shirt and
yeah, okay, all right. So back up. So first of all, Garrett and Ryan.
Yeah.
Garrett and Ryan are the two sober people at Burning Man, right? And no, I don't dress up. And people make like I'm the one person who doesn't dress. That's my costume. I dress up as a normal person.
I go comfortably. You had your Lululemon shirt on or something, you know.
So we've been to Burning Man together.
You fired me up so much that day, dude. I was like,
so this is what happened. So you just said that money is the tool really to sustain work and service to one another and new opportunities for us to pursue. And at Burning Man, it's another example of where there is no marketplace. There's no spending of money. And it works because it's 6 days long.
6 days, yes.
Right?
And there's tons of entitlement underneath that.
So much entitlement.
Yeah.
So there was somebody who came up to me and they found out that I run capitalism.com. And we had a very pleasant conversation, a very respectful conversation. But this person said, I think we can do better than capitalism. And I was like, oh, tell me more. And he said, well, just look around us. I mean, there's nothing being traded or bought and sold here, and it seems to get along just fine. And I said, that's an interesting point. Let me ask you a question. What's the one thing that is provided for us as a socialized thing? What is the one thing that gets provided for by Burning Man? And he said, well, the toilets, of course. And I said, have you been in there lately? When was the last time you cleaned them? And he said, I now see your point. Right.
My wife goes with a sheepy so she can stand to pee with the sheepy device because they're so disgusting.
Yeah. So, I mean, I like to say the purpose of money is to sustain service to one another. And when you're out in the wilderness, service is food or hunting on your behalf. When you're in the desert, it's a clean toilet or a glass of water, things that aren't available to you. That is the purpose of capitalism. That's the purpose of money. And when you understand that, you can go into service-based mode, which is creation mode, which is where you get fabulously rich.
So I love it. You said it so well. If we look at dollars, I'll say that money is a representation of a moment. It's a snapshot in time. It represents value, but it's not why we're valuable, and it doesn't dictate what our potential is or what we're capable of doing, but it does tell us what we can utilize with other people that they choose to freely opt into. And so, sometimes people confuse their self-worth and their net worth. The reality is that money is a byproduct of value creation, and as we create more value, it means that we have to take care of ourselves, but then as we take care of others, we actually get paid for that. Some people skip the step of taking care of themselves, or they think they're just taking from others. And that's where capitalism gets a bad rap, when people think capitalism is about taking, not creating. But there's no system that takes more than communism, and also stifles creativity, stifles ability, and has this great lie that people somehow are just going to wake up and be provided for. If you wake up and you're provided for with never doing anything, it means either A, you're part of the lucky sperm club, congratulations, right? Or B, it means it was on the back of another human being that didn't choose it, but was forced into it. So when we say, hey, we want this human right provided for us of healthcare, that's a human right. Well, who's providing it, first off? And is it now that they have to be a slave to providing for your healthcare because you've chosen it as a right instead of as a privilege? Right. Yes. And this is where it gets mucky. And look, I get it. Sometimes people have this bleeding heart because we all should care about one another. That's the key to make this thing work. But when we force that upon someone and we force them to care and force them to do, they're thieves, essentially.
Yeah. And what happens when you try to compel a doctor or a healthcare provider to perform a service? You get less willingness to perform a service. And so you have less providers. And what happens when you have less providers? The cost goes up.
Yep.
So the worst thing that we could do to make the costs go down is to make it, quote, free, to mandate it through government. You actually get the opposite result. Garrett, have you found a way to talk about the idea of the pie getting bigger rather than there being a fixed amount? Have you found language for this? Because I struggle with this when talking about it on capitalism.com.
Bro, I was just telling you, I'm working on this play. And one of the very early scenes, I go, money and resources are not the same thing. Let me go back to that part of the play where I go, all right, I'm just going to read it because I'm where I'm coming into it. But yeah, I think this is it right here. we buy into the belief that resources are like pie. We got enough cherry pie for everyone in the room, except for Ryan takes 3 slices. That means the people over here aren't getting any pie. That's scarcity, a perspective I call the consumer condition, where people take more value than they create, and it's a trap. Because money and pie are definitely not the same thing. Even if there's a limited amount of money, they're putting it on screens as we speak, there's an unlimited number of times it can exchange hands. We use it to buy computers and clothes, food and shelter, entertainment like comedy and concerts. Basically, the more times money is exchanged, the more value is created. Unfortunately, in the consumer condition, people make irrational decisions, especially when it comes to their money. The irrational decisions reduce value and destroy exchange. In other words, they do stupid stuff. So it goes on, but there's a whole 3 pages on this concept. Yeah.
Well, so that's interesting. I never thought of that idea of when you consume pie, it's gone. It becomes poop. You know,
Right.
but when you consume money, and it keeps getting circulated. And the very fact of if all you did was have money in the bank loans against that. The loans that they pay interest on that loan. It's back in circulation as soon as it's there.
Right.
So there's really no way to hoard money. There's no way to consume money. It's just energy that goes back into the system. Well said.
Yeah. Think of it more like a river, like the Amazon River, than a dam. Like the Great Salt Lake. I live in Salt Lake. Is a dead lake that has a stench. Nobody lives around it. It's just dead. But the Amazon River has so much flow to that river that there's miles of fresh water in the ocean where it enters. And there's an abundance of life to the point where we'd be scared to probably get in that river because of how much flow there is. And so money's about flow, and exchange creates wealth. The more times dollars are exchanged because we serve others, solve problems, or deliver value, the more wealth is created. So dollars follow value. If you want to create more value, create a more compelling vision. You want to create more value, solve a bigger problem. You want to create more value, discover what your talents are instead of expecting someone else to hand you something. Handing, like unearned income, where someone just hands it to you, that's called a gift, or it's called a curse, because sometimes when people inherit money, they feel different about it. They feel guilt and shame, and then they go, those damn 1%ers, I'm one of them, but I'm giving all my money away because they didn't earn it, because they're not stewards of it, right?
Yeah, and right now, you work with a lot of high net worth people. How are you approaching being a good steward of that money when we've got 0% interest rates, we've got a changing economy? Like, what's going on for you in this analysis? Has anything changed in your approach right now?
Yes, it has. So
Tell me.
So in the past, people could be a little bit passive with their money and be okay. I wouldn't call it great, but they could be okay.
Yeah.
But in the next 3 to 5 years, the transfer of wealth will be so substantial that if you choose just to set it and forget it, invest early, often, and always, put it in a public market and hope that it works out in a mutual fund, it's a very dangerous time and territory because of what's happening. First thing we have to understand is in the next decade, in the next 10 years in the United States alone, 50% of the wealth will transfer hands, because 418,000 businesses on average per year will be sold that are private businesses. We're talking about almost 5 million businesses in the next 10 years are going to exchange hands. Well, there's going to be people now that have that cash. There's going to be people that have to buy those. The second thing is the stock market has been overly propped up and overly valued without consideration for technological advance that will start to decimate it, and hasn't been taken into consideration a number of eroding factors. And the reality is 84% of the gains in the stock market are got by 10% of the investors, which are mostly hedge fund managers that are actually trading short and long at different times. So when they say the market did 6% in a year, it might be 3% for the average investor just setting money aside, and inflation is going to decimate that 3%. Now we have to worry about deflation first and then inflation next. But if we just sit on money, it's going to be worth so much less. And there's more money in the economy, which will go back into the hands of people who are buying businesses, buying real estate, or doing intellectual property. Everybody else that's just handing money over or setting on it and saving it without intention for it will find out it will be worth less, and that they will be in a more dangerous situation because the things that they want to buy that actually matter from an investment standpoint will be further out of reach. So it is a critical 3 to 5 years that people start taking responsibility with their finances and do something about it. Otherwise, the middle class is going to become lower middle class in the next 5 years, and the upper class is going to become really wealthy if they're thinking about investment and leverage and acquisition instead of savings.
Yeah, so in other words, in even 10, 15 years ago, having a more passive approach made a lot of sense. And I remember kind of the old business like presentation that would say like, well, you just park your money and get 9% per year.
Yeah, the
And
90s,
it made
you
sense
could
at the time.
You could get like 15% in the 90s. And some people's mind's still stuck in the 90s. We're in a time where it's going to be like 6 or less. So it's not, and inflation's going to be much higher.
So
now,
how do you figure that? Because that hasn't been the case in recent memory. I mean, we've had 20% gains for the last like 5 years or whatever it's been. So what's different in your opinion?
Okay, so I've done a little bit of detailed research on this. Okay, so if we look from the year 2000 to 2015, which, you know, there's a couple bad years in there. There's the 08 to 010, 2000 to 2002. But the market, if we look at actual companies that went out of business in the S&P 500, and instead of, see, one of the tricks they do marketing wise, you know marketing well, so you'll understand that there's people that do these things. When there's a company that goes out of business in the S&P 500, they just replace it with the next biggest company. Mm-hmm. If you lost money on that stock that went out forever, and yet they just replace it and say what the new returns are with the new company, not zeroing out your account. So your average return is inflated. Your average return is not your actual return because of that loss. And then the second thing is volatility has a major impact on investing. So if you have 100 grand and you lose 10%, you're down to 90 grand. Now, when they say the market's rallied, we're back up 10%, you're at $99,000 if there were no fees. But there was fees associated. They don't waive your fees during downtime. So now you have companies that go out, you have volatility that's impacting you, and then we take into account inflation. From 2000 to 2015, the S&P 500 did 8.7% total return net of inflation, 8.7 total. Now, obviously, there's 4 really bad down years in there, but most people look at, well, I had a 20% year. Yeah, you did, but you also had 20% on a lower amount when there was 3 years of loss. So you're way far back from getting back to even, and you lost time value of money over those 3 years. So we also just see in the future, like, dude, how many small companies are going to overtake these big companies? If we look at the S&P 500, how many of those 500 companies do we not really love doing business with? But we like other up-and-coming companies that are using technology that can displace and make those other companies irrelevant, that they were only relevant because of past retail rules, or they're only relevant because of acquisition structures that are in a different sector that will start to compete with them in ways they can't see because they're not nimble, they're not quick, and they don't have innovation. So ultimately, we're going to see a higher rate of decline with companies going out of business. We have plenty of volatility. You're watching the volatility like crazy right now. The fees are in existence, and that's not even accounting for, Ryan, flash trading. Flash trading is skimming some of the returns from the average investor. So there's just so much complexity in something that has been made to seem simple. And my problem with it is, why is it synonymous with the majority of Americans that investing equals stocks? I look at the bigger opportunity in the small business sector, because if we look at if we just look at the multiple for a major company, like if we're buying the stock at this price, what does that mean this company's worth? A lot of times it's 20 times what its actual assets are. Mm-hmm. I can't think of a small business that people are paying that for. If we look at 96% of small businesses do less than $1 million of revenue. So less than $1 million of revenue doesn't get big multiples. It would be shockingly rare. A lot of times you're buying for 1 to 3 times of EBITDA, which for those that don't know EBITDA, it's earnings before interest, taxes, and depreciation. It's just a way to calculate after certain expenses what the company is worth. So we can buy that at a deep discount, and there's actually more room for growth in a lot of those things, because a lot of business owners, as you know, neglect their cash flow, don't focus on their money. They're doing it all through hard work and effort without systems and structures. And so there's a massive opportunity to gain in the small business market, is way more than the big businesses, way more than the stocks.
Yeah, so let's go there, because I think it can be easy for the average person to see this as really bad news, but there's a lot of really good news in all of this too. Like when you mentioned that there's coming, there are going to be a lot of big businesses replaced by up and coming businesses. And sometimes that can sound a little bit scary, but if we look at the last 20 years, where was Amazon 15, 20 years ago? Where was Google 15, 20 years ago? Where was Apple 15, 20 years ago? These were emerging companies at the time. These were companies that were just a blip on the radar. And now they're $1 trillion companies. I don't know about you, but when I was a kid, $1 trillion was like saying a kabillion dillion dollar. Like it was a number that didn't exist.
Exactly.
Right. And now you have multiple companies that are worth $1 trillion. Where was Facebook 10 years ago? I don't even know if it was public 10 years ago. And so those who were looking at those companies are now fabulously rich because they were looking at where the world was going, right, rather than where we are and where we have been. I work with my business is capitalism.com. I help people start businesses, specifically physical product businesses, because that's where I've seen people get the most traction and hitting their first million in a year or so. There was just a case study that came out. It wasn't out of our community, but there's this company called Laird Super Creamers. Are you familiar with this company?
Super creamers? I know.
Yeah, so they're a powdered coffee creamer company, okay, right? And like it's big, and it's actually big in our little circle in like the paleo health community, right? So I'm
an amateur barista. I don't do powders. I just
very good.
Beginning, so that's
very good. So this company does about $19 million in top line revenue. They're not profitable. Okay, so they're growing aggressively. 19 million is nothing to sneeze at, but it's not like their Facebook, right? They just went public and they currently have a valuation of $425 million, Garrett. Now, that's ridiculous. That's absurd. And it makes no sense. And I don't care, because it just shows how valued good emerging companies are, which is why I think it's the best time ever to take control of your finances by becoming an entrepreneur. Even little things that you start can become massively legacy changing for you and your family. And there's case studies like RX Bar, which was started in some guy's basement and sold for $600 million. There's Mirror, which was just a company started by a husband and his wife, and they were bought by Lululemon for $500 million in 2 years. There's Native Deodorant, which was started by one dude for $500. He started with $500. He sold to Procter & Gamble 2 years later for $100 billion. There's a bunch of these case studies. And so there's plenty of good news happening while the structure of everything is fractured.
Well, and the other good news, you mentioned low interest rates, is for a down payment on a home, you can acquire a business. And with the interest rates the way they are today, the majority of those that you buy can cash flow from day one. Now, you have to get knowledge about it. You have to know what you're doing with it. You have to gain a skill set. But look, if people can go through school and learn math and science, they can learn business. Business is in some ways easier. In other ways, there's people and emotions involved, which makes it complicated. But, you've done it over and over, Ryan. So, you've got a formula. You understand how it works. And I just think that that's the news. The news is we've been trained, taught, and educated to wait for 30 years, hoping compound interest will save us. 95% of the time, people are not financially independent at age 65. So compound interest isn't the miracle it's purported to be. What is the miracle is cash flow and having entrepreneurship, because entrepreneurship comes with a lot of tax advantages and a lot of influence that you can do to have some degree of control over the outcome versus just hoping that it all works out. And so I think that it's a time for entrepreneurs to rise, because we have so many businesses coming onto the market, and there's so many things that can still be created or invented or dialed in. And Ryan, dude, when we were little babies, you and I were little babies, think about how much it took for someone to start a business versus now. The tools and infrastructure that exist that are near free or very inexpensive to help you to do something like that. I had someone that's a client that 2 years ago started a business on Amazon, struggling, does a call with my team. They're exiting for $3.5 million. Dude, they weren't even, I was just like, wow. And then they're like, hey, do you want one of these things for free? Thanks for all your help. And I was like, dude, it's crazy, because it's just amazing how short of a turnaround that was. And it was a mom that just was now, okay, my kids are out of the house, what am I going to do? And start a business. And within 3 years from the time it was started, is selling it for $3.5 million. I mean, that's pretty phenomenal. That's an exciting time to be alive. The bad news is we can't just sit around and hope someone's going to come save us, because government can't save you.
Amen.
Corporations won't save you, and effort isn't enough. It's time to leverage intelligence and add more value, and entrepreneurship's a beautiful vehicle.
The number one thing that helps you to drive value and dollars follow value comes down to who you are when you're at your best. How do you figure it out? How do you uncover it and discover it? There's some great resources if you follow the links here.